Okay, welcome to a video to talk about the notes for Chapter 2. In this chapter, we're talking about financial statements and the annual report, so it's really a continuation of Chapter 1. There's not a lot that's brand new in this chapter. Mostly it builds on what we already have done. The objectives of financial reporting are to basically give the information to the people that need it. And we talked about the 3 different kinds of financial statements that we use to communicate that information back in Chapter 1. And so here they're just giving a little bit more detail about what kinds of things we need to communicate with those financial statements. So to refresh your memory on that, for balance sheet, we're looking at the assets and liabilities and also the owner's equity for the company. For the income statement, we're taking the revenues and subtracting the expenses to show how profitable they were during a specific time period. And in the statement of cash flows, we're showing the sources and the uses of cash from the 3 different types of activities that we talked about. Keep in mind that along with the financial statements, we also have footnotes that describe accounting policies that were used so that we can better evaluate those things that are estimates and shades of gray, as we showed in the American Accounting Association model of what accounting is on the first day of class. The qualitative characteristics of accounting information, we talked about some of these, I believe, when we went over one of the quizzes. So we want the financial statements to be as understandable as possible. We want them to communicate relevant information that makes a difference in people's decisions. And we want the information represented to be as reliable and neutral and objective and error-free as possible. We also want it to be comparable, which means we should be able to compare 2 companies to each other for the same time period. And consistency means that we should be able to compare for the same company in 2 different time periods. Materiality means that the amounts of interest should be big enough to make a difference to somebody making a decision. And conservatism is the idea of using the least optimistic estimate if there are 2 estimates that are equally likely. A classified balance sheet is just like a regular balance sheet, except for it adds a couple subtotals. So for the asset section of the balance sheet, it divides it into 2 pieces. One is the current asset section, and the other is the non-current asset section. And the difference is that the non-current assets will last more than a year, whereas the current assets are expected to be used up or converted to cash within a year. Current liabilities are those debts that will be paid off within a year, and long-term liabilities are those debts that will be paid off in more than a year. And so that liability section of the balance sheet is also divided into 2 pieces, current and long-term. And then the stockholders' equity section does not get divided. There is no such thing as current or non-current stockholders' equity. So this just gives you a little bit more detail about current assets and what they are, and it gives you some examples of them. Cash obviously is cash. Marketable securities are stock that the company has bought in another company that they're expecting to hold for less than a year and then resell. Accounts receivable is things that customers owe the company. Merchandise inventory is products that the company has bought in order to resell. Prepaid insurance is when the company has paid an insurance policy that benefits a future time period, so it hasn't been used up yet, but we've paid for it. And store supplies is things that we've bought that we're going to use in the company that are going to last less than a year. So things like pencils and paper and stuff like that. Here's an example of what a current asset section of a partial balance sheet would look like. Now keep in mind, when you do a balance sheet for the first exam, you're going to be doing a whole balance sheet, not just a partial. So you can you don't have to worry about the formatting of these individual sections, except for as they apply to the entire balance sheet. Okay, so we've talked about the current versus non-current. The long-term assets typically are either investments, they're things that are not going to be sold within the next year, for example, stock we've bought in another company. Also physical assets, property, plant, and equipment. These are tangible. We can touch them. We're using them in our operations, but they're going to last more than a year. And then the intangibles are those that don't have any physical substance but still have value to us. So there might be a piece of paper that represents them that you could touch, but the value is not in the piece of paper. It's in the rights or whatever it is that this intangible thing uses to provide value. So things like trademarks and patents and things like that. The long-term assets, you may see them separated into these three categories on a balance sheet. You may just see an overall subtotal of long-term assets or non-current assets and then just see a list of them. So when I have you do a balance sheet on the first exam, you don't need to categorize them into those three categories, but you certainly can if you want to. Current liabilities, again, are those things that are going to be paid off within a year. Typical examples, but not a complete list, are accounts payable, salaries and wages payable, income tax payable, interest payable, bank loan payable. You'll notice that all of those have the word payable in them. Whenever you see the word payable, you can be pretty sure that account is a liability. And then you just have to think about how fast will it be paid back. So now there is one other current liability that you don't see on this list that is important, and you will see it most likely on the first exam, and that's the idea of deferred revenue. Deferred revenue is one of those exceptions that we have to just memorize because it doesn't have the word payable, but we have to think about the nature of what deferred revenue is, or unearned revenue is another label for that, and that's the one you're more likely to see as unearned revenue in this textbook. So unearned revenue represents the fact that we've received cash from a customer, but we haven't done what we need to do to earn that cash. So they've put a deposit on some products that we're selling to them, or they prepaid for the products, sent us some money and said, here's my money, please send me these products. We haven't earned that yet, so we can't record it as revenue until we actually ship those products. Or if they put a deposit down and we're going to provide services to satisfy that and earn that cash, again, it's unearned revenue until we actually provide the services. And so that is a current liability, unearned revenue. And again, we would just simply list them under the subheading of current liabilities and then total them within our balance sheet. The long-term liabilities are going to be paid back in more than a year. Typical examples are notes payable and bonds payable. Now, I should note that we can have short-term notes payable as well. So notes payable, you have to pay attention to what the due date is to know whether it's a current liability or a long-term liability. Another common example is mortgages payable. We simply, again, give a subheading of long-term liabilities or long-term debt, and then we list them. If there's more than one, then we would need to total it. Stockholders' equity, again, it consists of contributed capital and earned capital. The contributed capital is made up of the stock that we've sold to the owners of the business and any additional capital that they've paid in excess of the par value. For right now, you can just think of it as capital stock or common stock. When we get into Chapter 11, we'll talk a lot more about that paid-in capital in excess of par value stuff. And the earned capital is retained earnings. And again, what retained earnings is the total earnings the company has made throughout the entire history of the organization, minus all dividends that they've paid since the beginning of the company. So retained earnings refers to the earnings we've earned that we haven't paid out, so we've retained them in the business, and so that's what that is. When we show the stockholders' equity section, we'll put the contributed capital first, and then we'll put the earned capital, and then we'll total the two. Okay, so here's some new stuff for the chapter. I think most of the rest of what we talked about was review. Liquidity. Liquidity refers to how readily we can come up with cash to pay our debts as they come due. So how able are we to pay, especially our short-term debts? There's two things that we often look at to measure liquidity. One is called working capital, and the other is a current ratio. They both involve current assets and current liabilities. The difference between them is that the working capital subtracts the current liabilities from the current assets. And if it turns out negative, then you know you're going to have trouble paying your current liabilities as they come due. And then the current ratio divides the current assets by the current liabilities, and the higher the ratio is, the more able the company is to pay off those short-term debts as they come due. The current ratio is more comparable across companies because it doesn't depend on their size, what value you're going to end up with. Working capital, if you were to compare two different companies and one of them had current assets, let's say, of 1,000 and current liabilities of 1,100, you'd show negative working capital of 100. You'd know they're going to have trouble. On the other hand, another company might have $999,900 in current assets and $1 million in current liabilities, and when you subtract those, you're also going to end up with a negative 100. And yet the latter scenario would be much more risky than the first scenario that I gave because of those bigger dollar amounts. If there's any errors in them, we could end up with a lot lower working capital as a result, whereas to compare those two companies to each other, that current ratio gives a much better picture. Okay, the income statement. What we're adding in this chapter is the multi-step income statement. So we've already talked about the simple step income statement or single step income statement, where we simply take all the revenues and then we take all the expenses and we subtract the one from the other. What we're adding in this one is the multiple step income statement, which is going to classify those revenues and expenses as well as adding some important subtotals. You already know how to do this preparing a single step income statement, so I'm going to skip over that. And then preparing a multi-step income statement. With this multi-step income statement, you'll notice that we start off with a subtotal. We take the sales minus the cost of goods sold and we calculate this gross profit. That's the first subtotal that we're adding that's of interest in this. We also then are going to separate the expenses into operating expenses, which are selling expenses and general administrative expenses. And then we're going to add other revenues and expenses and income tax as well. The other typically includes interest, and interest is of special interest to us. No pun intended there. Once we subtract the operating expenses from the gross profit, that gets us a special subtotal or a subtotal of interest to us that's called operating income or income from operations. That basically tells us what portion of our income we expect to be recurring because it's based on operating activities. Other revenues and expenses, especially the interest, are less recurring, it's not that they're less recurring. The interest is actually very recurring, and so it has some special characteristics we need to pay attention to, but it's not part of operations, and so we want to list it separately. So we've got our operating income, then the net together of any other revenues and expenses that we have. And then that gives us a subtotal called income before income taxes, or we'll often just shorten it to income before tax. Then we subtract the tax expense, and that gets us to the net income. Now, no matter whether we prepare the income statement with single step or multiple step, the net income should be the same. So if you make two income statements for the same company and you end up with different net incomes, you did something wrong because they have to end up with the same net income overall. We're just reclassifying the different revenues and expenses in this multiple step income statement, but we're still accounting for all the same information. Okay, so let's try an example. Here you can see we've got financial statement items from Hoyer Inc., and we're going to prepare a single step income statement for this company, and then on the next slide we're going to prepare a multiple step income statement. And you also have examples of these in the Lightboard videos for a different company, so I would use both of these to practice with. Here we're going to use the account list and determine what should be on our income statement. And the first thing you should notice is that accounts payable is not a revenue or an expense, so we're not going to include that on our income statement. Same thing with accounts receivable. Accounts payable is a liability, accounts receivable is an asset. Cash is also an asset, so we're not going to include that on our statement. Common stock is an equity account. It does not go on an income statement. Cost of goods sold is an expense, so that one will go on our statement. Equipment is an asset. That will not go on our statement. Interest expense is an expense, so it will go on our statement. Interest payable is a liability, as is notes payable, so those will not go on there. Prepaid rent is an asset, so that will not go on there. Retained earnings is an equity account, so that will not go on there. Salaries expense is an expense, so that will go on our statement. Salaries payable is a liability, so it will not go on our statement. Sales is a revenue, so that will go on our statement. Matter of fact, that will be the first number that we show on the statement. And then supplies is an asset. It would say supplies expense if they intended for it to be an expense, and so that will not go on our statement. What we're then going to do is, come back. Okay, so we put the company name and we put the title of the statement at the top of the page. So we start out with the company name, Hoyer Inc., and the statement name, Income Statement. We then put the time period that's covered by this statement. In this case, we're doing an entire year. So we put for the year 2014, or you can word it as for the year ended December 31st, 2014. Both of those communicate the same information, so I'm equally fine with either way you word it. The next thing we do is we put the sales with its dollar number of $136,000. That's our only revenue, so we don't have to use the subtotal for total revenues. We just use that one number. Then we list our various expenses, and since we had more than one expenses, we put the title at the top of that subsection, and then we list the different expenses. So we're going to list cost of goods sold, which we said is an expense. We're also going to list the salaries expense. We're also going to list the interest expense. And that's all the expenses that we had when we went through our list. So we simply then total those, coming up with $108,500, and then we subtract that $108,500 from the $136,000 to get our net income as $27,500. So that is a single step income statement from a list of accounts. You will see a problem on the exam that will have you do an income statement. It might be a single step income statement like this one. On the other hand, it might be a multiple step income statement like the one that we're going to do on the next page. This is the same exact company. It's the same exact list of accounts, so we don't have to go back through the list of accounts. But now we have to reclassify those different items into the subtotals that we need for the multiple step income statement. The first thing we do is again put the title of the company, the title of the statement, and the time period covered by our income statement. The next thing we would do is we would start with sales. So right now we're at the same, it looks exactly the same as our single step income statement, but right away here it's going to be different, because now instead of putting in a subheading for expenses, we're going to make our first subtotal, which is gross profit. So we always start with the gross profit, then we subtract the operating expenses, then we add or subtract any other revenues and expenses that are not from operations, and then we give the total net income, subtract the taxes. So we're going to do our gross profit. We remember that that's calculated as the sales minus the cost of goods sold. So we put in the cost of goods sold as $76,000, and that gives us a gross profit then of $60,000. We then subtract our operating expenses, and I'm not too concerned about you showing the separate selling and general and administrative expenses on the statement. I do want you to know the definitions of what those are, but if you just give me a list of the operating expenses on a multiple step income statement, I'll be pretty happy. So we're going to put the salaries of $28,000. That happened to be our only operating expense in this company, because the other expense that we had was interest, which is going to be below our income from operations. So our operating income in this company is $32,000. Then we do the other revenues and expenses, which in this case we only had interest. We're going to subtract that, and that's going to give us our net income of $27,500. Now notice that normally we would subtract that interest and we would get a number called income before tax. In this case, because we didn't show any tax expense in our list, we won't have that subtotal of income before tax because we don't have any tax to subtract. And so we just put the net income in there. But if I had included an income tax expense or just tax expense item on that list of accounts, you would add another subtotal. So you would have income before tax minus the tax to get your net income. All right, so that's the example of Hoyer Inc. Next, we're going to do a balance sheet for Hoyer Inc. So you noticed that when we did the income statement, a lot of those account names we didn't use because they were there for the purpose of this problem, which asks us to make the classified balance sheet for Hoyer Inc. So the balance sheet, again, consists of assets, liabilities, and equity. And so we're going to start by putting the company name and the title of the statement. Notice we don't use the word classified on the title of balance sheet, and similarly we didn't say single step income statement or multi-step income statement on our income statement. We just put the name of the statement itself, just income statement or balance sheet. I don't want to see anything else besides those words in your title. The reason is because the classified or not and single step or multiple step, those are just procedures used in presenting the statement. The user will be able to tell by looking at the body of the statement which type it is. We don't tell them what type it is. They can see it for themselves. So don't add those extra words into those financial statement titles. Here we're then going to show the date of this balance sheet, and notice this is a point in time. It is not a time period covered. So we don't put for the year 2014 for the balance sheet. We just say, okay, at the end of that year, on December 31st, 2014, this is a snapshot of the company's financial results. And so we then start with our asset section of our balance sheet, and we're going to list our current assets first. I guess we can put the title over there for the liabilities and equity on the right side. And then on the asset side, we put in the current assets. Since this is a classified balance sheet, we do need to separate the asset section into current and non-current assets. Our current assets include cash. We typically list these in liquidity order, so whatever's already cash is going to be first, and then however quickly it's going to either be used up or turned into cash is the order they'll appear next. I'm not going to get too picky about the order. As long as you have them in the right classification, I'll be pretty happy. So after cash, we're going to list our accounts receivable, and that's going to total $30,000. Yeah, why is it going the wrong way? Okay, there we go. And then we also have prepaid rent is a current asset. That one won't be turned into cash, but it will be used up within a year. Sorry, I'm having a little bit of trouble with this thing. Let's see if I need to click on the other side instead. Okay, so then we also have supplies that are a current asset. And in this case, the supplies total $2,000. Now, what if that had been a big dollar amount instead of just a small $2,000 amount? That would not change where it gets classified. What determines the classification is the nature, not the dollar amount. And so it's the fact that the supplies will get used up within a year that puts them in the current asset section. We then total the current assets as $49,000. Then we look at our non-current assets, or we could call them long-term assets. In this case, we've got equipment for $95,000. That's the only one we have. So then we total up all of our assets and we get $144,000. Okay, next we go to the liabilities and equity side. We're going to list our current liabilities first. And so we'll put in accounts payable of $12,000. We've got interest payable for $2,000, salaries payable for $4,000, and that gives us our total current liabilities as $18,000. We then put in our long-term liabilities, which in this case is notes payable for $45,000. If we had had bonds payable or mortgages payable, those would also be there. Since there's only one, we don't need to total it. Then we add in our owner's equity. Now you could put a total liabilities subtotal if you wanted to, and so add together the $45,000 and the $18,000 to get $63,000, and then put the owner's equity in. That's fine. I didn't require it on this particular one, but it would definitely be good to put it in. So I wouldn't mark you off for doing a good thing. Owner's equity is going to consist of common stock of $50,000 and our retained earnings, which was given to us as $31,000. And then we add together the total liabilities and equity, and we get that same $144,000. Notice we double underline the two totals to show the fact that they are equal. We know they're equal. We see them balancing. So it's important to do that once you reach that stage. All right, so there's your example of a classified balance sheet preparation.